So today's session is on equity mutual funds. We've been doing a lot of sessions on stock market analysis as well as options. Hello. Uh, but also I wanted to touch upon something which is related to mutual funds. So I just created a simple 5-point checklist, things that you should at least basically be aware of before you are selecting an equity mutual fund for your investing. So that is what we are going to look at today. So equity mutual funds investing, just a simple 5-point checklist on things that you should be aware of, at least regarding which kind of a mutual fund you are investing in and what, where your money is going basically. So I hope you're all aware of what a mutual fund is. A mutual fund is just for those who are not aware, and very basic thing about a mutual fund is, it's an organization, or it's a firm that pools together all the money from the retail investors and then invests on behalf of the retail investors. Yes, we'll do different types of funds also. So Contra and ELSS will be, they are a subcategory of equity mutual fund. So we'll look at all the parameters of equity mutual funds. So basically, a mutual fund is an organization that pools together the money for a retail investor and invests according to the stated objective of the fund. And so the benefit for a retail investor is manifold on different levels. One is that very small amount of money can be put in, and it can be put in periodically. Like when you're doing an SIP, it can be put in periodically, and you get the benefit of diversification. You get the benefit of multiple assets. You get the benefit of different geographies also. And basically you can plan your asset allocation, you can plan your geographical diversification or asset diversification, and like ELSS is there, so you can plan your tax benefits, and so a lot of things as a benefit for the small investor who wants to have an exposure to the equity market. So that's the benefit of having a mutual fund. And as you know, the mutual fund industry has been growing by leaps and bounds in India. Even now the participation is very low compared to the entire market, but still there is a lot more to come. So this is an industry that is growing, and a lot of people benefiting from it. But there are some basic things to know, so we'll also look at that. One of the advantages of being in India and in the Indian mutual fund industry is one of the highly regulated industries across the world. In India, the mutual fund industry is highly regulated, and you can say the level of transparency in terms of portfolio disclosure and all the other stuff that is being they are mandated to disclose is one of the highest in the world. So that is one good thing about being in the Indian mutual fund industry, especially the equity mutual funds. And the kind of disclosure, the kind of transparency, the kind of regulation is one of the highest in the world. So that's a benefit. Disclaimer: I'm not a SEBI registered analyst, so these are not trading or investing recommendations. But we are not talking about the stock market today, but I'm a registered certified mutual fund. I'm certified for mutual funds, so that's good. So but these are nothing related to stock market. Okay. So basically the MF categories, like you were saying, ELSS and contra funds, and so there are various type of funds. This the terminology. If you're not aware, just a quick discussion on that. So when you say large cap fund, okay, when you see like some company which is called large cap or blue chip, okay, these are the terminologies that are used for large cap, blue chip. That means that fund is investing in the top 100 companies of India as defined by market capitalization. Now, if you see the Nifty 50, which is the top 50 companies Or if you see the Sensex, the BSE Sensex is the top 30 companies of India based on market capitalization. So market capitalization, what is market capitalization? Market capitalization is the number of shares floating in the market multiplied by the price. That's the total value of the shares available in the market or floating in the equity market. Okay, and that is how you find the market capitalization. So the top 100 companies in terms of market capitalization. So you will have Reliance, HDFC, Infosys, TCS. These are the top companies by market capitalization. And once LIC will come in, LIC will also be I think the fifth or fourth or fifth in terms of market capitalization. So large cap means it is investing in the top 100 companies. Okay, so the moment you see large cap in any fund name, or you see blue chip, you understand that it is investing in the top 100. The moment you see mid cap, that is yes, active and passive. We'll come to that. So the moment you see mid cap companies, it is the next 150 companies, leaving aside the top 100, starting from 101 to 250. Those are the 150 mid cap companies. Mid cap means in the middle in terms of market capital. It's not large, it's not small, it's in the middle. So middle level market capitalization, that is what is called as mid cap. So it is the universe for a purely mid cap fund. The universe for a mid cap fund is 150 companies. Now if you see a company, if you see a fund that is large and mid cap, that means the universe for that fund is 250 companies, the top 100 and plus the 150. Now what is small cap? Small cap is, as you would understand, all the other companies which are not large and mid, they are all small in terms of market capitalization. So starting from 251 to all the 5,000 or the 6,000 companies that are listed on the stock exchange, they all come under small cap. Okay, so yeah, what is the difference between an active and passive equity fund? The question you're asking, Rishabh. So an active mutual fund is where the fund manager takes the decision on which stock should be included in the fund. Okay, the fund manager is actively managing the fund, and the fund manager takes decision on which suppose let's say it's a mid cap fund, 150. So he has a universe of 150 companies, and on an average a mutual fund will be holding around 45 to 50 to 60 stocks at the max. So out of this 150, which 60 stocks should I hold? That is the decision of the fund manager, and if he is actively managing the fund, that's called an active fund. While a passive fund is a fund that follows the index. Okay, that follows the index. So let's say you will have a passive fund which is called Nifty 50, the index fund, Nifty index fund, or you have the Sensex index fund, or you have the mid cap index fund. So if it is a Nifty index fund, the fund manager is not going to do anything. He is not going to use his brain. Okay, he will just take the Nifty 50 stocks and invest in proportion to the weightage in the index. Okay, so if the Reliance has the highest weightage, assuming 15% weightage, then 15% of the money that he has, he will put in Reliance, and and similarly all the other 50 stocks. So that is called as a passive fund. So there are passive funds that are tracking different indexes like the Nifty index or the mid cap index, or all different indices. So in that, the fund manager is not using his own mind. He's not using his brain. He's simply tracking the index. Whatever is there in the index, that I will buy in the same weightage. Now there are some funds which are equal weightage funds. So in that, what they do is that they are not differentiating according to the weightage of the index. Rather, they are saying that we will put equal money in all the 50 stocks. Let's say for the index, I'll put if I have 5,000 rupees, I'm going to put 100 rupees in each stock. That is equal weightage index. So small caps have the highest risk. Yes. Why do small caps have the highest risk? Because basically they are small companies, and we don't know whether they will go and they'll go on and become big companies or not. there are hundreds of, thousands of small companies, and many of those companies will burn out. Okay, they will be lost over the next 5 years or 7 years or 10 years. We don't know whether they will survive or not. And therefore, if you're putting your money in a small cap fund, you also understand that this is the highest risk, not the highest risk, but one of the in the equity category, it is one of the highest in terms of risk. Yes. So Rishabh, if active funds are better in the sense that you are opening yourself for a chance, for a chance to beat the index. Okay, you're saying, okay, I trust the fund manager, and he because the fund manager is actively working, and so this fund is supposed to give me a better return than the passive fund, than the index fund. Unfortunately, around 70 to 80% of the active funds are not able to do this. And one of the reasons why they are not able to do this is that, in spite of being called an active fund, they are still more or less, 60 to 70% of the portfolio that they have, they are mirroring the index. Okay, so in spite of being called as an active fund, in spite of being saying that the fund manager is actively picking stocks for this fund, around 70 to 80% of the portfolio is still mirroring the index. What is the reason? Some of the reasons will be that we as a nation, as a stock exchange, as a company, in terms of the companies that are listed in India, we don't have so much breadth. Okay, the highest liquidity is narrow in the terms of small caps and mid caps. Not many people are investing over there, right? So there is no liquidity. Now a fund is transacting in crores, and so it needs liquidity, it needs volume if they want to buy something out of the universe of the top 100, right? So that is one limitation that we have in the Indian market. So our breadth in terms of, and breadth and depth in terms of liquidity is still growing. So that is one limitation that we have. But in spite of that, so you will see that many active fund managers are still mirroring the index. 80 to 90% or 70 to 80% of their portfolio is still the top index, and so therefore they are not able to beat the index. So ideally, what you're saying, theoretically, it is true that an active fund is supposed to beat the index, but it is not happening. It's not happening. But going forward, I am a believer in the active, active fund management space. So there are a lot of people who say that because the active funds are not doing well, that's why you should keep yourself to the passive. You should invest only in the passive funds. Why? Because the passive funds are cheaper in terms, because the fund manager is not working, right? Fund manager is not actively, using his mind for that. So it is cheaper. The expenses are low, while the active fund management charges are higher. And if the active fund management charges are higher and still they are not able to beat the index, then what's the point of being in an active fund? The question is valid. It's valid, and so what I even though personally I'm a believer in the active fund management space, and I think that going forward there will be a lot of funds who will not mirror the index, who will work hard and try to find out real multi-bagger stocks, and they will identify from the mid cap and from the small cap space, they will identify those stocks. So that kind of fund management will be there. So because this is such a growing industry, and that active fund management space will be much more lively than what it has shown in the past. Yes, right. But let's say you are doing a large cap fund. Okay, large cap fund. Now the large cap is the top 100, right? Where will the fund manager go? Out of the top 100, he can't go anywhere else. So if you're limiting yourself to a large cap fund or a blue chip fund, then it is better to follow the index. Yeah, it is better to follow the Nifty index or the top 100 index, because the universe is limited, and therefore the active fund manager does not have too much of space to wriggle around, to manage those funds. So it is better to go for what do you call the index funds, the passive funds. But in terms of flexi cap or in terms of mid cap or small cap, I think I'm a believer in active fund management space, and I think that this category will show more promise in the days to come. Although till now, there is not much to show for. Okay, ELSS is where your tax saving comes. So it is a block for 3 years, and you get a tax benefit on it under Section 80C of the Income Tax Act. So the total limit is 1,50,000 that you can do. And flexi cap is your diversified fund, which means it has a dynamic allocation. Okay, now what is the difference between flexi cap and multi cap? You see, there are two categories here. One is flexi cap, another is multi cap. Both of them are diversified funds. But the difference between flexi cap and multi cap is the flexi cap. In flexi cap, the fund manager has the freedom to dynamically allocate between large, mid, and small, and he can overall around at least 65% should be in equity, but he can decide how much should be in large, how much should be in mid, and how much should be in small cap. So the fund manager can decide where to put, how much allocation to put to mid cap or small cap or large cap. While in multi cap also is a diversified fund, but 65% should be in equity, but the at least 25% should be in small cap and mid cap and large cap, right? So 75% is fixed. So out of 100 rupees, 25 rupees has to be put in small cap. It's a fixed allocation. So and another 25 in mid cap, another 25 in large cap. So that is the difference between flexi cap and multi cap. What is a focused fund? A focused fund is a fund that holds only 20 stocks, 20 or 25 or 30 stocks. You can see focus 25 or focus 30. So it is holding only 25 stocks or 30 stocks, and that are the top concentrated bets, that are the best bets. At that point of time, the fund manager feels that these top 25 stocks are the best bets right now. So they are not diversifying into 45 stocks or 50 or 60 stocks, but they are just holding those top concentrated. So if you're investing in a focused fund, remember that this is a concentrated fund. Okay, so that means that your risk is also concentrated, but at the same time your return can also be higher than a fund that is holding let's say 45 or 50 stocks. But if a fund is holding 45, 50 stocks, that also means that your risk is diversified, and therefore volatility is bound to be lesser than a concentrated portfolio, right? So that's a difference. And then you have sectoral and thematic funds. Like sectoral, like they invest only in one sector, infrastructure sector or banking sector or pharma sector. So sectoral funds. And then you have thematic funds, like multi-allocation funds, or you have specific theme like the energy theme or something like that, and you invest in that particular theme, right? And then you have index funds. We already discussed index funds, that which are tracking the index. Okay, right. Now how do you check all this? So I have a checklist here. There are 5 things, 5 simple checklist. Okay, so performance, risk, portfolio composition, and management. Okay, these many things we need, at least the basic information we need to have. So let's see how you will check the performance of a fund. Okay, this is moneycontrol.com, and you come into mutual funds here, and I am seeing here the performance tracker. Okay, what is a contra fund or a value fund is both having a similar type of an approach. So contra fund or a value fund, what they do is that it tries to find a contrarian view, opposite view. It tries to look at stocks which are undervalued as of now, which are not in the limelight. Nobody is advertising it. It's not in the limelight for whatever reason. And if it is something that will go on and build value in the future, build wealth in the future, then they are trying to identify those kind of value stocks which are available at a very low price. So it's not in fashion. It's not in fashion, right? Sometimes technology stocks are in fashion, or banking stocks or metal stocks are in fashion, but the value funds tries to identify those sectors or those stocks which are not in fashion right now. Nobody is looking at it. It's not being advertised. It's hidden somewhere, but could potentially unlock a lot of value in the future. So it's a contrarian view of the market. The market has a particular view, but the fund manager has a contrarian view, opposite view. So those kind of funds are known as the contra funds and value funds. We'll try and look at those funds. Right? Let's see what is there in that space. So you have this apply filter. These are the contrarian funds. We'll try to rank it and sort it according to the rank. And we have SBI contra fund here at the top. Okay. Sorting is not proper. It's 5, 3, 2, 5, 4, 4. Okay. Okay. Let's ideally, if you're looking at this, you should look at even though funds that are not ranked. You should look at, because you don't want to be limited by what other people have ranked or some organizations have ranked. Sometimes you can find very good picks even in the ones that are not ranked by by rating agencies. So ideally you should look at those two, but for the time being, just for the sake of analysis here, I'm just removing this and only the 5-star and the 4-star. Okay, fund parameters. There are other things also by which you can filter it. For the time being, we'll do this. Okay, so you have SBI Contra, ICICI Value Discovery, IDFC Sterling, Nippon Value. Okay, let's look at, what are we looking at? We are looking at performance, and we are checking returns against the benchmark and category, and we want to check SIP returns also. So we are looking at SBI Contra Fund. What is the benchmark? The benchmark is S&P BSE 500 is the benchmark, and the BSE 500 has given 14.6% over the last 1 year. Okay, let's look at 5 years. So the BSE 500 total return index is 13.1% over the last 5 years. In comparison, the SBI Contra Fund has given 14.96%. So slightly higher than the benchmark. You can see this recently it has gone high. Okay, it was lower, but recently it has performed higher than the benchmark. Okay, so good enough. What is the SIP return? SIP returns over last 5 years is 21% annualized. 21% annualized over 3 years is 34% annualized. Good enough. So that is one thing that you want to look at. Okay, is it performing better than the benchmark, and is it performing better than the category? Look at this, the category average. So what are the other contra funds doing? The other contra funds are giving on an average 17.95% return, while the benchmark, I think BSE 500 is not an appropriate benchmark because it takes 500 stocks, while the philosophy of this fund is actually to look for value stocks. So I don't know whether that proves to be a sufficient, it's not an appropriate indicator here. But this category will serve as a good, comparison. So the category of contra funds is giving 17.95 on an average, while SBI Contra Fund is giving 26.89 over last 1 year. Okay, let's look at 5 years, 14.93 and 14.96. This is a better comparison. Yeah. So it is very close to the category. Over 5 years is close to the category, and it has performed. It has started doing better recently. Okay, so that is good. Yeah. SIP returns. The category over last 5 years is 14.93, 14.96. Oh, okay. SIP returns is here. 21. We already saw that. Right. Now that is one thing that you want to see. the next thing that you want to see is risk adjusted returns. Okay, they are giving better returns than the category, but are they taking more risk? What is the risk being taken to give a better return? That is also something that you want to know. That's why we have risk adjusted returns, and there are some measures which are used to check risk adjusted returns. So we look at that. Let's look at that. Okay, so you see there are risk adjusted the measures that are used to check Sharpe ratio, Trainer's ratio, and Jensen's alpha. These are some of the ratios that are used to find out how much risk the fund is taking. Okay, so standard deviation, this is the volatility in terms of return. So a low volatility is better. So the category average is 20.84, while the volatility for this fund is 20.16, which is lower than the category. It's good. What is the beta? Beta is again a volatility indicator. How volatile the fund performance has been compared to the similar funds in the market. So a lower beta is better. So 0.88 means one is if the beta is 1, that means it is moving as per the market, same as per the market. The volatility is the same as per the market. Now 0.88 means the volatility is lower than the market, which is good, right? The category average is 0.94, close to 1, but in this fund the volatility is lower than the category, which is a good. That means it is giving higher returns with lower volatility, right? So that is good. Then you have Sharpe ratio. Again, this is Sharpe ratio is it subtracts the risk-free return from, like, the Indian government bond. What is the return on the Indian government bond? That is the risk-free return. Subtract the risk-free return and then divide by the standard deviation. Then you get the Sharpe ratio. So the higher the Sharpe ratio, the better. If the Sharpe ratio is higher, then it is better, because that means that for per unit of risk, it is giving higher return. Per unit of risk taken, it is giving a higher return. So 0.92 is the Sharpe ratio here. 0.72 is the category average. So you have better risk adjusted returns on this fund. Trainer's ratio is also same per unit of risk taken. But the only thing is the denominator that is used over here is standard deviation instead of beta. The denominator that is used over here is beta, and the denominator that is used over here is standard deviation. That's the only difference. So again, you have 0.21 versus 0.16, which is the category average. So you have better risk adjusted returns. Now, okay, so alpha is the last indicator is alpha. What is the additional returns that this fund has generated over the benchmark? That is what alpha shows. So you have alpha is 5.89 and the average is 1.5. So on an average across the category, the alpha is 1.5, which means it has performed 1.5 better than the benchmark, while in this case it is 5.89, which is much better than the category. So you have alpha, which means the fund itself is doing something much better than the benchmark, and the fund itself is doing much better than the category, and that's why it's something they are doing something better. That's why the alpha is showing such high. Okay, so these are the risk ratios that you want to see, so that you are able to compare between funds. Let's say you have a fund that gives you 15% return, two funds that give you 15% return. How do you compare between those? Both are giving the same returns. How do you compare between the two? You want to see the risk ratios. What is the risk that the fund is taking to give 15% return? While if the other fund is giving 15% return, taking a lower amount of risk or lower volatility, that means you have a better risk adjusted return. So you always want to go with a fund that gives you a better risk adjusted return lower volatility, same return, or lower volatility, higher return. That's the fund that you want, right? What is the portfolio? The next thing that we want to see is what is the portfolio. Now, to understand the portfolio, it would be good if you have an idea of the stock market and which are the stocks that are inside here. It would be good if you know that. But even if you don't know, just a simple analysis of this portfolio will also give you an understanding. Okay. So one of the first things that you want to see in the portfolio is that whether the portfolio is according to the stated objective of the fund. Whether the portfolio is according to the stated objective. So what is the stated objective of this fund? The stated objective of this fund that it is a contra fund. It is supposed to find value where there is, where the market is not looking at right now. So does this portfolio enable you to know that, or is this portfolio, according to the stated objective? Where are they investing in? The top holding is GALE. Yeah. And then HCL Tube Investments, Neogen Chemicals. These are some names that you may not have heard of, right? NMDC. So there are a lot of PSUs in this. GALE, and then NMDC, State Bank, and then ITC, very defensive stock. Okay. So these are the top 10 in the portfolio. So if you are able to analyze in the stock market also, what is Tube Investments doing? What is Neogen Chemicals doing? Is there any kind of a value in this? If you're able to do that, it's not necessary that you do that, but if you're able to do that, you can analyze the portfolio on the stock, and you can also view the complete holding here. Let's say the top 5 stocks, what is the weightage? 13.99. Well, the category has 25% almost. The top 10 have 25%, 38%. So it is lower than the category. It is lower than the category. So they are not a very concentrated portfolio. The portfolio is much more diversified than the category. Holding in large cap, 35% holding in large cap, while the category has 52%. Wow. So this may be one of the reasons that it is performing better than the category. You see, only 35% is in the large cap, while they are trying to find more value in the small cap, while 13% is in the category. 13%, the category is invested 13% in small cap, while they are invested 23%. They are trying to find out value here. And 11 and 15 more or less very similar in the mid cap segment. Okay, but they are less in large cap and more in the small cap. You also want to decide whether you want to take this kind of risk or not. If they are more in the small cap, do you want to go? Do you want your money to be invested more in the small cap? That's one of the decisions that you can take while you are looking at the portfolio. So when you look at portfolio, you want to see whether they are moving according to the stated objective of the fund. That is one. Second thing is that what is the composition of the portfolio? Like we saw, the allocation in large cap, small cap, and mid cap, or the allocation in terms of what is the concentration here? Top 5, top 10, top 3 sectors. What is the concentration here? What is that kind of composition? Okay. What is the investment style? And what you want to see is also the portfolio turnover. I'm not very sure whether the portfolio turnover is given here or not. I don't think there is a portfolio turnover here. Okay, yeah, here it is. Portfolio turnover ratio is 128%, while the category average is 161%. So you want a fund in which the portfolio turnover is lower. Okay, you want a fund where the portfolio turnover is lower. Why? Because the more the portfolio turns over, the more expenses. Okay, and it also shows that it's also for a fund manager, if he has a lot of conviction in his investments, then the portfolio turnover is likely to be less. Okay, so this is not you cannot make a decision just based on this criteria. but so this is one of the things that you can look at. And lastly, we want to look at the management. Who is managing the fund? Who is managing the fund? What is the expense ratio? This is 1.29% here. Category average is 0.93. So the expense is a bit higher than the category. Yeah. What is the exit load? And AUM for this assets under management. What is the AUM? What is the size of the fund? Okay, all these things have a bearing on the investment style. If the size is very huge, it may be very difficult for the fund to change in between, right? They change their moves in between, while a smaller fund will be more nimble. So that is the impact that the AUM can have on the fund. Who is the fund manager? That's what you want to look at, and how many years this fund manager has been with the fund. What is the style of fund management, and the expense ratio. Right? And taxation, of course. Taxation. If you have an equity fund, the taxation will be similar for all the equity funds, unless you are doing some kind of a hybrid fund or a debt fund. Only then the taxation will be different. So long-term capital gain over 1 year, and if the fund is investing 65% or more in equity, then long-term capital gain for more than 1 year. And for all other funds, long-term capital gain is for a holding of 3 years or more, and anything less than that will be short-term capital gain. So that is how you want to look at the management and the scheme details of the fund, and accordingly try and select a good fund which is suitable for your objectives, for your goal, right? That's all I wanted to say. Anything that you would like to ask, any questions that you would like to ask, you can ask to me right now. And you can connect with me on capitalworx.in for anything related to mutual funds, equity, stocks, insurance, portfolio management, training and mentoring. Do connect with me on capitalworx.com or .in, or on my email at ideas@capitalworx.in, linktree/capitalworx, LinkedIn. You can also connect with me on LinkedIn and other channels. Right. Any questions that you would want to ask? Okay, I guess no questions. In that case, we'll call it a day. Thank you for joining. Okay, thank you for joining, and have a nice day.